tools, and how much discretion should be left to central bankers. Reflecting that debate, different jurisdictions have arrived at somewhat different answers to how constrained discretion should operate when you're in an inflation targeting framework. For example, the Bank of England's monetary policy remit bears many similarities to frameworks with a dual mandate. Given the widely held view that money is neutral in the long run, both involve a focus on inflation stability in the long run. In the short run, both involve balancing inflation volatility with a concern for output volatility. And both lend themselves to be formalized in terms of a quadratic loss function, which is where the Greek letter lambda comes into the story, of course. But there are subtle differences between these two, however, and I would highlight two. The first is in the clarity with which the remit acknowledges that inflation in achieving the inflation target is the best and only contribution that monetary policy can make in the long run. The primacy of price stability in the MPC's remit makes clear that there are times when the focus should be squarely on returning inflation to target, and there are limits to how high lambda should be. In that sense, our remit is more constrained. But second, and subject to the first, the MPC's remit affords more flexibility over how management of a trade-off should be approached than a dual mandate, which, almost by definition, can be taken to suggest that a balanced approach should be taken. I would argue that this additional flexibility that we have can be useful in allowing monetary policy to approach trade-offs in different ways, depending on the circumstances. Explicit language on how trade-offs should be managed gives clear directions on how the choice should be approached, however, and a clear framework for accountability to Parliament. So that begs the question, of course, so how does the MPC's remit suggest we should respond to the recent rise in energy prices caused by the conflict in the Middle East? Well, monetary policy generally looks through the direct effects of energy prices on inflation. It takes time for changes in interest rates to affect the economy and inflation. So higher interest rates might only push inflation below target once the energy price shock has passed, resulting in undesirable volatility in both inflation and activity. And even if the lags in the effects of interest rate changes were shorter, offsetting the direct effect of an energy price shock would require pushing down core inflation by generating additional slack in the economy. Looking through the direct effects of an energy shock avoids such output volatility as the MPC's remit calls for. In other words, a higher value of lambda is appropriate with respect to the direct effects of an energy price shock. Because they take longer to come through, the argument for looking through the indirect effects is weaker, and protracted indirect effects could keep inflation above target for too long unless monetary policy responds. This suggests a moderate value of lambda for the indirect effects. By leaning against indirect effects, monetary policy may also reduce the risk that higher inflation becomes embedded through the higher inflation expectations and second-round effects. Such effects could arise, for example, if a rise in inflation expectations leads workers to bargain more strongly for wage increases, and firms raise wages to maintain real pay for their employees, which in turn would increase their costs and could lead them to set higher prices. Monetary policy should not look through such effects. For second-round effects, the appropriate value of lambda is low, consistent with the primacy of price stability in the remit. But the size, of course, of any second-round effects, in addition to the direct and indirect effects, is highly uncertain. And in addition to being highly uncertain, second-round effects build up more slowly than direct and indirect effects. And that leaves monetary policymakers with a difficult judgment call. Because interest rate changes take time to take their effect, we can't wait for conclusive evidence of the strength of the second-round effects. But responding too early may generate undesirable volatility in output, and inflation may drop below the 2% target in the medium term, if second-round effects turn out to be smaller than anticipated. I would argue this speaks to the desirability of a state-contingent approach, including with respect to the choice of lambda. Given the context of softness in the real economy and uncertainty around the scale and duration of the shock, tolerating temporarily above target inflation to provide some support for the real economy is an appropriate way to approach the trade-off. But that tolerance would weaken if signs of second-round effects begin to emerge. So this takes me back to the scenarios. In the monetary policy report that we published at the end of April, we presented 3 scenarios, A, B, and C, for possible outcomes for the UK economy and inflation over the next 3 years, without any one of them being designated as a central projection, as we normally would do, and without assigning any probability weights to them. This is not because we expect this to be the norm for the future. Rather, it reflects the uncertainty we face with the unpredictability of the situation in the Middle East. As and when we can be more confident about how world events will unfold, we will return to presenting a central projection, one that the MPC agrees is reasonable baseline, using scenarios as vehicles then for exploring the inevitable risks around it and exploring differences of views within the committee. But for now, the scenarios we think give us a better way to think about the policy discussion. The reality of the situation we are in is that there is a range of possible outcomes, and we have to be ready to respond to all of them. Using scenarios like this is part of being ready to make that response, whatever happens. And it allows us to set policy now with a clear sense of the risks we have to balance. The scenarios are designed to capture the key questions that are relevant to the policy discussion. How long will the conflict go on? What will be the scale of the effects on energy prices of the conflict? And particularly important for us, could it lead to second-round effects and inflation persistence? The scenarios do not pretend to be exhaustive of what could happen. They're meant to illustrate somewhere around the range of possible outcomes. While we are ready to adjust course as needed, depending on how the situation evolves, our decision to hold the policy rate at 3.75% at our most recent meeting was an active choice, given the range of possible outcomes. Having taken expected cuts off the table for now, we've already tightened policy considerably in response to the shock relative to what had been expected by markets. And that's already affecting financial conditions and the economy. Key quoted rates on mortgages have increased since the onset of the conflict. So the decision to hold reflected a judgment that continued weakness in the UK activity and the labour market is likely to lessen the strength of the second round effects from higher energy prices, while recognising that these effects are likely to be stronger the larger and more persistent is the rise in global energy prices. Uncertainty about the strength of the second round effects means that monetary policy needs to balance the costs of leaning too little against these effects against the cost of responding too much. And the right balance is likely to change depending on how events unfold and how the economy reacts. To state the obvious, that means, of course, that we have to monitor very closely the situation in the Middle East and how it affects the UK economy and inflation, and adjust policy as required. But whatever happens, the use of scenarios and the flexibility that we've built into our processes following the Bernanke review has prepared us well for responding to events as they unfold and to returning inflation to the 2% target in line with the remit and for the good of the people of the United Kingdom. Thank you. We've got a big choice of chairs.
Okay, yeah. Thank you very much, Governor. That was great. You talked a lot about the importance of discretion and I guess the other way of thinking about discretion, or another way of putting it, is that it's just the ability to respond to different situations in a different way.
Yeah.
Of course, looking at the UK, what's happened in Europe, 2022 also saw an energy shock, also saw rising inflation expectations. How different is the current situation?
That's a great question, yeah. I think there are several differences that are important here. One is to remember that the energy shock in 2022 came in two parts. So we had a February 2022 initial outbreak of the conflict in Ukraine, and then we had the bigger one came in around August, really, actually. So it had a different characteristic. But I think the bigger point I would make is the legacy of COVID. The problem, I look back on this, particularly sharply now. The problem we had, I think, was judging how tight, particularly the labour market was. Every forecast that I know, and we publish a summary of outside forecasts in every monetary policy report we publish, had unemployment going up in the UK, and this includes our forecast, by the way, when the so-called furlough scheme came to an end. In other words, when the state paying for people to stay in jobs but not be at work came to an end. We all thought there was going to be, I think I got asked repeatedly, how much scarring do you think there's going to be? And we all thought there would be, and we all thought there would be an increase in unemployment. I mean, the furlough scheme was a great scheme in many respects, but it obscured the read of the labour market, I think. So, of course, what happened was exactly the opposite. We had no increase in unemployment, the labour market became tighter, and it became very clear, talking to companies, that they were, quotes, hoarding labour, deliberately, that they were worried about if they lost people, they wouldn't be able to get them back. Now, I think today, we're obviously not in that position. I mean, there's always an interesting task with reading the labour market, but I don't think that we're in that level of uncertainty. The picture of a gradually softening labour market comes through pretty consistently.
And is it, obviously you had that experience, you learnt, what some would say, you learnt quite a few lessons from that experience because the labour market was not as we thought, as many people thought. There's a lot of questions now around UK credibility, both on inflation, given the recent record, but also clearly the political uncertainties, which we're seeing in market pricing, particularly in bond markets, but also in inflation expectations. Is it harder for you to be using that discretion in this quite different situation, given that sort of legacy that you're carrying?
I think the legacy makes it a bit harder because I think if you look on the other side of the picture to the sort of the softening labour market, softening activity, going the other way, put on the sort of on the other side of the balance would be inflation expectations. And, I think we're very aware that, the legacy of 4 years ago does weigh in people's assessment of what inflation expectations are in response to the shock we're having at the moment. So, I don't think we should be surprised that there's some element of what you might call hangover from that period. But of course, we have to take that very seriously into consideration because it's real.
But does the change in inflation expectations mean something different this time because of what's in the labour market?
Well, I think that's where it gets really interesting. Because I think that's a judgment that weighs very heavily. You're precisely right, because what you can end up with is somewhat more elevated inflation expectations, but it isn't coming through in wage expectations when they're measured, and it isn't coming through in wage settlements at the moment, particularly in the private sector in the UK. So again, that's I think, as I said in the remarks, judgment is absolutely at the centre of what we do, and I think that judgment between those two things, what weight do we put on the read from inflation expectations versus labour market expectations is very important.
And I guess that means, at least on the outside, it sort of seems that you wouldn't only be looking at inflation expectations as a clue to second round effects, which is obviously the main thing you're worried about. So if it's not that, what other indicators are you going to be looking at?
So we look at a whole series. We're not going to be specific about a particular indicator. There are elements of the inflation series because I think things like services inflation give you some reading on the sort of underlying state of the domestic economy more so than some of the other bits of the index. Labour market the only problem in the UK we'll have is that there is a distinct seasonality to private sector wage settlements, and we've passed that season before the shock happened. So we don't get as much information for the remainder of this calendar year on...
And that involves waiting quite a long time.
Yes, as well. And that's the challenge, going back to what I was saying. The other thing we do is I spend a lot of time going around the country talking to companies, and we're doing a lot of that. And we come into this, I think, with companies telling us quite consistently, before the shock happened, that they were finding it hard to pass costs into prices. So if you think back to sort of events that happened, over a year ago, if you think back to things like the national insurance change, minimum wage changes, companies were telling us quite consistently it is getting much harder to pass those through. And I think probably by the end of last year, we were concluding that a bit more of it was coming through in reduced margins.
So the implication of what you were saying about a legacy is obviously you feel conscious of that, the trade-off between wanting to be seen to be responding quickly, but waiting for those second round effects. Has the bond market tightening actually bought you some time on that?
It probably has, but there's a number of things going on there, I think. So, as I said in the remarks, I mean, one of the things, we have in effect tightened policy, in my view. Now, this does depend, you'll get different answers, from different members of the committee on this, because it depends what you thought you were going to do for the rest of this year before any of this happened. I'd been quite clear, I thought we probably would cut rates once or twice this year. That's off the table. So, we've had, as I said in my remarks, we've had about a 1% increase in mortgage rates for new mortgages, so for the 2 and 5 year fixed rate mortgages. That's obviously a tightening of financial conditions. So that's real. I think the other thing we've had is that the UK bond market has responded somewhat more, and this is linked because I think we've seen this very big change in the makeup of government bond markets, including our own. So there was, I think, more than you would see historically positioning, particularly in the sort of the hedge fund world, on the basis that we were going to cut. And that positioning has come off largely. So you had a bigger sort of reversal of positioning going on. And I think that also has had some effect on the UK curve. It's coming down now progressively over the last couple of weeks. I hope it goes on. I think that will depend on events in the Middle East, I think.
Does the UK, we're running out of time, but does the UK have a problem here, and is it a puzzle for the Bank of England? I mean, the neutral rate, the rate at which we can sort of not have a problem with inflation, just seems to be meaningfully higher than you might have expected.
I mean, this is one of the great puzzles, I think, that I think we all spend quite a bit of time on as to how you sort of square neutral rates. We do have a more open economy. That's one of the sort of arguments we sort of come back to eventually. So that may have some bearing on the question, I think. But it is something that we do look at very carefully. And I do think this question about are we going to see market rates now come down will depend a lot now on what goes on in the Middle East. But I also would say this about the UK, and it sort of goes to I don't comment on the detail of fiscal policy, but I think if you look at it through the eyes of the market, I think the market responded very positively to the budget last autumn. And they see that, of course, that with the shock and the consequences of that in terms of energy prices, they obviously see a pressure on that.
Governor Bailey, we want to make sure that we're not behind schedule all day as they were yesterday. So thank you very much.
Thanks, Stephanie. Anyway.